Welcome back to Power Lunch. Stocks are under pressure today, with the Dow heading for its third straight down session and the Nasdaq down more than 1%. And Treasury yields are jumping. The 10-year back to 2007 highs. It's at nearly 4.5% after the Fed put a pause on rate hikes for now, but signals fewer rate cuts next year. Let's bring in Brian Jacobson, chief economist with Annex Wealth Management, and Kevin Mahn, president and chief investment officer at Hengen & Walsh Asset Management. Kevin, I'm going to ask you a very simple question.
Yes.
What do you think is going on here?
I believe, Kelly, that July marked the end of this rate hike cycle because if the Fed raises interest rates by just 25 basis points more this year, that's going to potentially push us into a recessionary period during the first half of next year. Why is that? Because it's going to put more of a burden on the U.S. consumer that's over-leveraged, a U.S. consumer that now has over $1 trillion worth on their credit card, a U.S. consumer that put over $43 billion onto those credit cards in the second quarter alone. And now they're facing credit card interest rates above 24% before another potential rate hike. And we've started to see delinquencies pick up. Just last quarter alone, they rose to their highest level in more than a decade. So if the Fed's intended consequence is to push the economy into a recessionary period, then raise by another 25 basis points. If they want to navigate the soft landing, let that July rate hike be the end and keep them at higher for longer, perhaps into the second half of next year.
Ryan, you agree with that?
Well, in a way, I think that actually maybe the Fed has already done too much in the sense that if you look at some of the data on the amount of interest and debt expense as a percentage of personal income, it's gone from 1.4% and it's shot up to 2.4%. That's consistent with the historical average, but to get an average, you have to have periods of time when it's above and below. And I think that it's just going to keep marching higher. So I would actually probably just say that the Fed has already done a little bit too much here. And the effects of that are going to start at the bottom of the economy. Lowest income individuals who are more heavily indebted. Also on as far as the markets, lowest quality stocks. Typically, it's the smallest ones as well. Those are probably going to be starting to feel the pain first, the most, and probably as early as the fourth quarter. So I really wouldn't wait until next year to say that we're going to experience the beginnings of a recession. And remember, a recession starts at a peak of economic activity, not at a trough.